And on this down day in the markets, we have a look at one sector that does continue to outperform. That would be the banks. Bob Pisani shines a light now on the bank stocks and tells us whether or not the rally has more room to run.
Banks have been the standout performers for the second quarter. The large cap banks are up over 10%, well outperforming the S&P 500, up just 2%. And investors have noticed, as these stocks started breaking out a month ago, volume in key ETFs like the Spider Bank ETF, that's a basket of bank stocks, saw a surge in volume. So what's moving these banks? Improved economic data has been a big help. So there's been hope that loan growth would improve. Well, that's slowly happening, but it hasn't translated into big revenue growth because rates are so low. The most important factor, though, in the bank rally has been the belief that short-term interest rates would eventually be moving up and the yield curve would steepen. Most bank loans are tied to those short-term rates. Investors are trying to figure out if they should continue to chase this bank rally. Deutsche Bank made a very bold call today by downgrading Citi and Goldman Sachs for exactly this reason. They acknowledge the economy's improved, but the huge rally in these stocks means there is much less upside in their opinion. Now, not everyone agrees with that. Others have told me that if the Fed funds rate moves in the right direction, the direction the Fed wants them to move, gradually up into next year, that would provide a significant lift to the bottom line of many banks. And in that case, these banks can definitely move higher. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.